got a great question from a viewer that we thought we would address in a video format such as this, and that is on stops, guys. A new trader asked, why do I keep getting stopped out of trades? We're going to talk about stop placement, one of the most important things to learn when you're starting out in the market. Proper stop placement, regardless of your time frame, is going to prevent this problem, guys. Let's talk about stops.
The thing about stops is, like, you wonder why your stops get run.
Right.
It's about, like, it's an overly simplistic answer, but I'm going to have to say it anyways because I was literally just talking about it. If somebody is a larger trader and has a lot of shares and is looking to maybe have it go one direction or the other, the cost to have it go an extra few cents so that it hits that level, gets a bunch of people out. In this case, I'm going to talk about Weber. If it's at $10, psychologically, it's a monster level. Going to the higher time frame, it's a monster technical level. There are going to be stops galore, whether it's people wanting to stop break long, whether it's people that have stops that want to be short in front of it. So if it gets very close to that price, and all of a sudden there's only a few thousand shares on the bid or offer, well, it's very likely to get stop hunted. Because if it goes a couple of cents above, everybody understands that a lot of stops are going to get triggered. A lot of people who might have that short on will get stopped out. And if that's a simple case, that could have washed out some of them, and then somebody can get back in underneath. And we talk about it all the time. If you think a big move is going to happen off of that level, like you think you can drop $1, well, then don't have your stop exactly at 10 even. Give it to 10.05. Maybe give it to 10.10. But you do that because you're expecting a bigger move, so you're willing to take a bigger hit. That's part of the game. If you're scalping it, sure, sometimes that even stop is fine. But if that level is way too obvious on the chart, you're not the only one that sees it, and there's stop hunters out there, and sometimes you just got to give it that extra few cents.
I was kind of laughing at the beginning of the question because it's like, why am I always getting stopped out? It's because you're on the wrong side of the trade.
There's another answer, obviously.
There is another answer to that one as well. But look, Neil and myself, Brendan, we all trade with stop orders. I mean, if you can't trade multiple symbols at once without having stop orders, or maybe you can and you're just not trading big enough shares, which would be fine as well. I think the most important thing when you're talking about stop orders is just to understand what your time frame is, whether or not you're trading for the day, for the week, for the month, and you know, why are you stopping yourself out? What is the reason for that? And I mean, Neil just did the work on the chart. I just want to talk more about the mental side of it. It's like, I think that you should stop yourself out, when you've sort of reached a certain plateau as far as profit is concerned. And I know we say hide your net, don't worry about that. But like, if you take 1,000 shares of, I can even go over here on Bed Bath & Beyond and just do something that's a little more dramatic of an issue here. This is a 20-minute chart, right? And it's like, if you take 1,000, like if you're looking at the chart like this, let's pretend that we don't see any of this here. We don't see any of this move breaking past this 17 mark, okay? But like right there, that top is 17 right here on Bed Bath & Beyond. So I wouldn't have any problem if you made that high and then you said, you know what, I'm going to go short the next day. Now forget about the fact that it went to 15. Maybe you took profit, maybe you didn't. But the point is that if you don't have a stop here at that high, then no matter what amount of shares you have, look what happens after that. It rips up to $28 or $29. So basically, you're going to lose everything. Like, if you're short at 17, the best it can go to is zero. So you're going to make $17. But you lose $12 real quick right there in about a week if you don't have your stop order. So for me, it's like you can look at charts and pick these levels, and I think you should do it. But also, I think the important thing about stop orders is you have to have the comfortable amount of shares so that if your stop gets hit, that you're okay losing that amount or making that amount of money, right? And so that to me is the key thing about stop orders. Don't let yourself get greedy. If it's only a $2 move down that you've noticed here, like it goes to 15, then maybe your stop, if you're short at 17, maybe put your stop at 19, like $2 risk to reward type of stuff. So I like to say that sure, there is technical reasons, obviously, to place your stop order, but a lot of the time too is, don't let your greed or your lack thereof responsibility, especially when you're short, to overtake where you should put those stops. So I think there's a technical level, and there's also a level where mentally, this is too much for me to hold. I have to get out.
I love that concept, and the simple fact of going back to the beginning and saying, is the idea, is the thesis behind the trade still valid? If yes, then why are we stopping out? If no, then you got to stop yourself out of the trade. So there you go. Hope that helps. A few really great tips there, guys, on how to properly place your stops.